So Delia, to start things off, maybe you could give your thoughts on the alternative asset space in general in this in recent months in the last year or two in the wake of rapidly rising interest rates, inflation, geopolitical tensions, various other factors. What shifts do you see having happened already in the alternative asset space, and what are the opportunities and challenges that you're looking at going forward in the near future as well?
Yeah, so over the last few months, we definitely saw a big shift, I would say, in alternative investments or emerging kind of asset classes. We see that with the kind of introduction of the Bitcoin ETF that draw a lot of attention, and a lot of kind of institutional investors started paying attention to this kind of new asset class. The benefit of adding those alternative or emerging asset classes to a bigger portfolio is that they have a low correlation with the traditional stocks and bonds. And this is because they're influenced by different market dynamics and economic factors than the traditional assets. So they usually respond to geopolitical events or inflation pressure in different ways than the traditional assets. And adding those asset classes to a traditional investment strategy increases diversification, which is critical because it spreads risk across various assets, and they can move in different directions during different economic cycles. Now, the caveat of adding those new emerging assets to traditional portfolios is not straightforward, because first, the risk associated with this new asset class is not very well defined. And the second, there is a need for robust valuation models. And right now, everybody kind of is struggling to build those models. So from a risk point of view, in traditional markets, you know that the work has been done right? So we have robust and very mature ways to measure and manage risk. We know that you have the financial risk, which is the market risk, the investment risk, the liquidity, the credit, the counterparty risk. And then you also have the non-financial risks, which are kind of the regulatory risk, IP, whatever, operational risks. So those are all acceptable standards that everybody is comfortable operating with. However, when you add those emerging new asset classes, then you have the new risk that comes with them. And in this case, is the technology risk, is the decentralization, the smart contract, the open source, composability. And they are all associated with this digital asset class, and they need to be really understood and quantified before adding them to the portfolio to do the diversification that is needed. On the return side, and I'll touch on this a little bit, is just that I always say that the risk and returns are the same side of the coin. Investors still need to build a very robust valuation models. And few months ago, I talked to a senior fund manager at a large bank about patterns in those new asset classes. And it's interesting because usually when the new asset class starts, the reaction is, don't touch it. Don't put it on my balance sheet. Don't allow to trade it. But the second phase is, oh, that's kind of interesting, but we don't have good models, right? So we are still using Excel spreadsheets to compute the expected returns. So don't get too big. So right now we are at this phase. This is where we have institutions saying that, yeah, maybe put 2 to 5% in digital asset. If it blows, it's not going to kill me, but we do have an upside, and I can actually learn how to model that.